is there one single favorite indicator? If you had to toss out all the, dozens, if not hundreds of indicators that you track and you had to rely on one, what would it be? And I will never forget what his answer was, which is dueling bull or bear covers on Time and Newsweek. Where if you had a bull, literally a bull on the cover of Time and Newsweek in the same week, that was almost a telltale sign of a market top. Wow. And vice versa if you had bears. Now, obviously, that type of indicator has adjusted over time because we don't read magazines. We get information real time in nanoseconds and we're barraged by it. But I think a lot of the concept around sentiment indicators still holds true today.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Okay, welcome to this episode of The Bull of Wall Street. My name's Talley. I'm the Chief Market Strategist of the Wealth Consulting Group, and I'm joined by my co-host Jim Warden, our CIO, and Paisley Nardini, our ISC consultant. And this time we're excited because our special guest is Lizanne Sonders, the Chief Investment Strategist at Charles Schwab. Welcome to the show, Lizanne.
Oh, thanks for having me. I'm looking forward to our conversation.
Awesome. Well, we've been looking forward to it here as well. And maybe I'll just tell a quick story of how we're connected. Lizanne, I don't know if you remember, but we've crossed paths a few times over the years. The first was about, I want to say 18 years ago at the ISI morning meeting when you were a client.
We still receive ISI's research. So that relationship goes back even before my time at Schwab to my time at Zweig Avatar. So it might have even been longer ago than that, but you have a good memory, Talley.
That's great. Well, I guess all roads lead back to ISI at one time or another. But the next was at a Stanford CFA Society forecast dinner. And I want to say that was back in the 2011-16 period. I can't remember which year, but it was the one with Pim Fox moderating.
Mm-hmm. I remember.
That's awesome. And now it's been several years since our last encounter. So this is a nice catch up with you.
It sure is. Thank you.
Yeah. So in fact, Jim, I think we're clients of hers now. So the table has turned, right?
Yes, we are.
Well, thank you for being clients.
We're thrilled. And Lizanne, I've never actually met you in person, so this is awesome to talk with you and learn from you. I was going through some of your prior podcasts that you did and reading some of the things that you've wrote. And so I'm Paisley and I are both CFA charter holders, and we do the Kaya and alternatives. Went to an alternatives conference a couple of weeks ago. But I'm also a CMT, and I'm curious about your mentor, Martin Zweig. Am I saying it right?
Marty Zweig. Yep.
So I saw a podcast that you did, I think a few years ago, and you had mentioned something about him getting out of the market before the crash of 87. I would love to hear more about that. That's pretty incredible.
Yeah. So in fact, I would urge you, a lot of younger folks these days have no memory of a show that was on PBS for years and years and years called Wall Street Week with Louis Rukeyser.
That's right.
And
yeah.
Famous.
The best way to sort of relive Marty's perspective on the market and the calling of the crash is just go on YouTube and, Google or search in YouTube the episode that occurred on the Friday night just prior to the crash of 87. So I think the crash was on October 19th. So it would have been October 16th of 1987. And it's a real interesting, fascinating look at what his perspective was and how unbelievably perfect he nailed it. And he didn't just nail that a crash was coming imminently, but actually laid out that we would then have a relief rally, we'd retest the lows, and then we'd be off to the races. But I was 1 year in the business at this time. So I started
Wow.
there in the summer of 86, right out of undergraduate school. And I was a grunt. I did whatever, Marty and his partner, Ned Babbitt, asked me to do. I didn't know much about the market, but I learned pretty quickly in real time. But what was fascinating about that period is because we were asset allocators, tactical asset allocators, maybe shorthand for which was market timing. And Marty did it to a more significant extreme on the hedge fund side of the business, the Zweig Domena Partners, which is still running, courtesy of Joe Domena, where they could go to more extreme positions. And that side of the business basically went to, via options, being net short the market over only a few weeks span of time prior to the crash. On the institutional side, the Avatar side of Zweig Avatar, we were a little bit more constrained. We were not running a hedge fund. We were managing institutional assets for foundations and endowments and corporations. But we did go from close to a fully invested equity exposure, I think at the high in August, and then started to move to what became only about a 20% equity exposure, literally the week prior to the crash.
Oh, wow.
So here, naive me, 23-year-old me thinks, and then the crash happens, and it happens exactly as Marty suggested it would.
Wow.
And then we were off to the races, and we started buying in the immediate aftermath of the crash. So my naive mind is thinking, why is everybody freaking out? You just figure out beforehand that the market's going to crash.
Yeah.
That was
You
easy.
get out, and then the market crashes, and you get back in, easy peasy.
That's right.
Needless to say, that is incredibly, incredibly difficult. And but he was really prescient. Everything aligned. All the stars that he was, an astronomer of really just aligned. The technical conditions, the sentiment conditions, the understanding of monetary policy and where it sat. It all aligned. And it was just this sort of epiphany that he had by virtue of what his models were telling him, and he nailed it. But I learned the hard way, maybe a little bit harder way, that it's not easy, and market
It's not
timing
that easy.
is almost impossible to do consistently well.
Wow, that's an incredible story. So those indicators that he was looking at back then, do they still apply now, or has the market changed so much to where that's just different?
They do still apply, certainly the sentiment conditions, but
Mhm.
but maybe in a little bit different a way. I remember one of the interviews that Marty gave to, I don't even remember what the publication was, and it was after the crash, but the interview wasn't specifically about the crash, but he became even more well known and popular as a result of that. So it was just
Wow.
an interview about his indicators, and he kept hundreds of them on that green graph paper. And he got asked a question that might have been by Barron's of is there one single favorite indicator if you had to toss out all the dozens, if not hundreds of indicators that you track, and you had to rely on one, what would it be? And I will never forget what his answer was, which is dueling bull or bear covers on Time and Newsweek, where if you had a bull, literally a bull, on the cover of Time and Newsweek in the same week, that was almost a telltale sign of a market top,
Wow.
and vice versa if you had bears. Now, obviously, that type of indicator has adjusted over time because we don't read magazines. We get information real time in nanoseconds, and we're barraged by it. But I think a lot of the concept around sentiment indicators still holds true today. Marty invented the put-call ratio. That's obviously still widely used as a behavioral measure of sentiment. He coined the phrase, "Don't fight the Fed." He coined the term, "The trend is your friend," a very widely
Wow.
followed breadth thrust indicators called the Zweig breadth thrust indicator. So there's myriad things that he studied and was in his parcel of indicators that still absolutely apply today. but there's a lot of them that you have to think a little bit differently about as a result of just the changing landscape of how we get information.
Sure.
I'm happy to hear what you said about bears on covers, and hopefully that'll bode well and the timing's good, because it's actually the cover of our next piece for this week. So, but
Is
of
it a
those
bear or is it a
indicators,
bull?
well,
It's
a larger bear in the surveys than bull. So
Okay.
from a
All right.
contrarian perspective,
Well, okay.
hopefully it's
There you go.
positive. Yeah.
I hope so too.
But I remember you years ago writing about the TRIN. Is that one of the indicators that would come up? And what is it kind of telling you now? Are you looking at that?
Gosh, that has sort of fallen a little bit off my radar. I don't know if it would have fallen off Marty's radar if he was still around, but it's kind of fallen. So I actually don't have a perspective on what it's saying right now, because it's not something that is in my sort of recent parcel of indicators. And maybe one of these days whether it's AI embedded in our brains, we'll be able to say in our own mind, pull up a visual, holographic chart of the TRIN and let me analyze it while I'm also conducting this podcast and weigh in on what it's saying right now. But we're not there yet.
That's
I feel like we're getting close, though.
I saw that. You've got your
Maybe.
own pod. That's great.
We have our own pod.
Everyone gets a pod.
Yeah, actually, one thing too, and I don't want to take us off course here, but just talking about more of like sentiment indicators and such. I listened to the recent episode, Liz Ann, that you had recorded, and the conversation between some of the hard data and the soft data.
Yeah.
And what that's telling us, which kind of goes to Talley's point on kind of really extreme negative sentiment coming from more of like the soft data.
Right.
But I'm sure Talley has us going there at some point. So Talley, if that's on the agenda, awesome. And if not, let's add it.
Oh, 100%. Before I want to kind of take a step back,
Mhm.
because I wanted to ask just another kind of get to know you question, Lizanne. How long have you been at your role now at Schwab, if we just fast forward the tape a little bit there?
Yeah. So for all intents and purposes, I've had 2 jobs in 39 years on Wall Street, which I don't think is par for the course on Wall Street. So I was with Zweig Avatar for 13 years, from 1986 to 1999. And then I joined US Trust in 1999, but less than 10 months later, it was acquired by Schwab. And I've been basically in this role ever since. So 26 years doing this. So
Wow.
I effectively really went from a bottom up kind of role. I was a portfolio manager and essentially a stock picker in the context of the top down tactical asset allocation work done, down from Marty. But all along the way, I was always more fascinated by the top down component of it than I was with the bottom up component. Having worked as a portfolio manager for a long time, it's not where my passion was. I didn't love it. I was always more fascinated by the top down. So when Schwab acquired US Trust, and Chuck Schwab himself literally came to my office in 2000, along with our CEO at the time, and said, "Hey, we want to create this new role for Schwab of Chief Investment Strategist. Do you have interest?" And I said, "Absolutely." And
That's awesome.
that was more than a quarter century ago.
Well, see, so no, I like to hear that. And that's why I asked, because I've always admired your leadership in the industry. And
Thank you.
you've been, as you describe, a successful strategist since well before it became popular to hire women into these roles. And now at WCG, we really take pride in having a relatively high share of female advisors who I think will be inspired to hear your story
Well
today
done, you
on the
guys.
pod.
Good job.
Yeah. But Jim, why don't you take the opportunity there just to talk a bit to Lizanne about our gender lens model and what it is and how it works?
Yeah, no, happy to do that. I just, we the Wealth Consulting Group really wants to, make our environment for advisors very inclusive.
Right.
And we do have a lot of female advisors, and actually some of the feedback from our female advisors were that, hey, do you have any portfolios that are geared toward women? And we didn't have any. And so Jimmy Lee, our CEO, and myself were looking at it, crunching the numbers, and we, there were a few other firms, not that many, that were starting to look at these gender lens types of portfolios. And so we built it, and like, it's focusing on women on the board, women in management, women executives. We're looking at things like diversity and median worker pay. And so, yeah, and that portfolio is done really well. And we actually have one advisor who's talking to some very high net worth individuals that are women, and they love it. It's fantastic.
Absolutely.
So, we want to spread the word.
There are so many studies that have been done about however you measure corporate success, whether it's stock price or sales, reputation in their industry, you name it. A more diverse sort of management team or board tends to lead to better performance. It should be obvious, but sometimes it's important to still state it. Not to mention, I think the other important reason for that focus, especially in our industry, is it was now a number of years ago where we crossed the sort of chasm, so to speak, where now more than 50% of the wealth, all the wealth in the United States, is controlled by women. So we're talking about, the investor base. You better have some gearing toward who's controlling the money out there. So this is not just let's check the diversity box, the gender diversity box. It goes well beyond that.
Absolutely.
And why
we appreciate all that you've done, and you're kind of like, leading the way. You're on the Barron's women list, and this is just an honor to speak with you.
Oh, thank you. Well, I think being a woman in our industry is a huge benefit. I don't see it as a hindrance. I think just being maybe a little bit different. Certainly, almost 40 years ago when I started in this business, it was seen as, boy, you're climbing an uphill battle. But being different, I think, was a plus if you had the mindset to look at it that way.
Yeah, I concur with that. I even think too, maybe I have also been lucky where I've landed at different firms and the teams that I've worked on where they've really valued the diversity of opinion.
Yep.
They've valued having representation beyond kind of looking in the mirror. And I think that's only continued to grow as well. So I concur with you, Lizanne, that I think it is actually a bit of a tailwind or an advantage where firms are seeking, whether it's, our profile or our background or our experience that may be underrepresented.
All right.
And Paisley,
I think there's a female superpower. I wonder if Paisley would agree with me.
Yeah, I might be biased, but I think I agree.
100%, I agree too. Well, I know I would not be.
Yes,
I would not be the CIO that I am without my wife.
So it is. I would agree with you.
She keeps me in line.
Multitasking is our superpower.
Yes.
I think too, women tend to listen more, just broadly. That's a broad brush statement. And just the relationship aspect of how we work with coworkers and we want to collaborate and such. Not that men don't, of course they do. But all these kind of puzzle pieces come together, I think, to just build more robust teams that are more productive and better for share price at the end of the day.
Agree.
Well, Paisley, that's why you're on our investment strategy committee. So thanks for your contributions.
Absolutely.
But I know she's chomping at the bit to ask you an economic question. So,
okay.
And I think I for one, I saw, Lizanne, your March 17 piece where you talk about the hard and soft data. But Paisley, why don't you kick us off with that question?
Yeah, I think it would, like, as you mentioned, Talley, I think it just kind of comes full circle with how you're thinking about markets right now and really seeing this as this backdrop today as maybe more opportunistic than scary. But Lizanne, would love your thoughts broadly on how you're viewing kind of the divergence from hard data and soft data today, what that might mean for investors over the next couple months. That's obviously been pretty rocky.
Yeah.
But in these pockets of uncertainty, there's always opportunity lingering. So is it more that the hard data will catch up to the soft data? Is it vice versa? Like, how are you thinking about this? And how can investors think about this going forward?
So the last time we saw a big divergence between the soft data that weakened and then the hard data that stayed more resilient was around and in the aftermath of the big spike in inflation in 2022, which led to the most aggressive tightening cycle by the Fed. in 40 years. And we saw a huge compression in the soft economic data, the survey-based data, confidence measures, which ultimately wasn't corroborated by the hard data catching down to the soft data. You ended up eventually seeing the soft data catch up to the hard data. I think the backdrop is different this time. I think we're later in the cycle. The tentacles of why the soft data has weakened in terms of actual impact into the hard data, the not just the tariff uncertainty as a concept, but the impact actually of what is already happening and will happen as a result of much more significant tariff policy than was the case back in the 2018 period of time. I think we're later in the economic cycle. We're already seeing it work its way into some of the hard economic data, particularly of the leading variety, like the big pickup in layoff announcements. So, and then you add the Doge component of uncertainty into the mix and the tentacles of that into the economy, particularly the labor market. And I really think that the labor market is what holds the key here. That may sound like a duh statement. I mean, the labor market is always important, but it was the resilience in the labor market during what became a manufacturing recession post-COVID and a housing and housing related recession didn't ultimately take services down with it, because we had the rolling nature of strength and weaknesses in the post-pandemic environment. And services is a larger employer. You had the later pent-up demand on the services side, also fueled by stimulus. That kept the labor market afloat. There was legitimacy to the whole labor hoarding idea. That kept the labor market afloat. And even in the context of the excess savings being drawn down, traditional savings rate coming down, you did not see that filter into weaker consumption. And that was because of confidence in the labor market. So I think if we were to see more meaningful cracks in the labor market beyond what we have already seen, which are minimal, then I think it could feed into weaker consumption, which is right at the heart of economic growth as 2/3 of GDP. So my bet is that best case scenario this time is probably not likely to be what we saw a few years ago of a big catch up by the soft data. To me, best case scenario would be a little bit of convergence where you maybe see some further weakness in this hard data, but then you start to see the soft data improve as it looks forward. But I think worst case scenario, which is not a low probability, would be the hard data catching down to the soft data.
Yeah, and maybe just some initial thoughts there too is whether it's Doge or just broader, industries and sectors paring back, just given the uncertainty. I think that's one thing that I believe in is the next couple months we'll continue to see uncertainty as it relates to tariffs, as it relates to broader policy. It's a bit of the chicken and the egg. But with that, companies will continue to kind of sit on the sidelines, whether it's hiring or production. And so that becomes this self-fulfilling
CapEx investment and
Exactly.
and not just businesses that are in wait and see mode and moving to the sidelines, but monetary policy authorities, certainly the Fed that moved to the sidelines. And now there's, rumblings out of Europe that central banks might consider going into pause mode. So a halting of activity and a kind of a squashing of the animal spirits that became very prevalent and escalated quite quickly in the aftermath of the election. I think that, the spirit animal of animal spirits at that time was arguably a bull. And now I think maybe the spirit animal in the weakening of animal spirits might be more of a bear.
I like that. And so we've had a kind of, to your point, Lizanne, a crisis of confidence, and it's very prominent in the consumer sentiment data, which you've mentioned. Is it possible? Are we talking ourselves into recession here?
Well, quite frankly, economic cycles are driven by psychology. I don't think that there are a lot of unique components to this uncertainty given policies around tariffs and Doge. But the whole notion that animal spirits drives the up part of a cycle and the waning of that drives the lower part of the cycle, that's forever in history. It's driven by psychology. We often talk about the psychology on the investment side of things, investment sentiment indicators, which touched on as it relates to that being, Marty's bailiwick. And there's sort of a version of hard and soft sentiment indicators in investor sentiment where it's, survey-based measures of sentiment versus actual activity behaviors on the part of investors, and that drives market cycles. We all remember the late great Sir John Templeton famous quote of bull markets are born in pessimism, they grow in
Right.
skepticism, mature in optimism, die in euphoria.
Yep.
You could apply that same thinking to economic cycles too. So there's absolutely a psychological component. So yeah, there is that notion of the vibe session and sometimes soft data that isn't corroborated by hard data. And that may be the case this time too. But when you do see a halt in activity, it absolutely can work its way into recession level conditions, especially when you're later in the economic cycle, as I would argue we are now.
Yeah. And you both just now, you and Paisley just mentioned uncertainty going hand in hand with the dip in sentiment. And I love this question, and I always have my answer teed up. But what do you think, Lizanne? Is uncertainty good or bad for stocks?
Well, the whole old line of the market hates uncertainty, I always giggle at that as if there's ever a time that the market is certain. I mean, that's kind of silly.
Very
There's
true.
always
Right.
there's always uncertainty. I think what it references more this time, and it filters into the market not liking this kind of uncertainty, is that it's frozen activity. So that's how the uncertainty this time is manifesting itself. And it's again, it's the what is the playing field? The Business Roundtable discussion of a couple of weeks ago in DC, where CEOs and CFOs, their overarching message was just tell us what the rules of the game are, and we can navigate around that. Companies are unbelievably good at adapting to whatever playing field they're on. And I think the message is, what is it is it a soccer pitch? Is it a football field? Is it a ping pong table? Is it a, pickleball court? What is the playing field here? And then we can figure out how to adapt and operate under those circumstances. So I think it's the uniqueness of this kind of uncertainty and the halting of activity that is maybe a bit different this time.
Yeah. Well, Jim and I, we love uncertainty because it creates tremendous buying opportunities for patient long-term investors. And one of
Sure.
our key charts is the contrarian inverse relationship with between policy uncertainty, which is high, and the stock market. And you see over time that elevated uncertainty lines up pretty nicely with tradable lows in stocks. But Jim, why don't you kind of chime in here, because you were talking about the candlestick and hammer and what's going on in markets.
Well,
CMC
today is an interesting day just from a technical standpoint, just because we started off kind of on a really bad note and things finished well. I mean, and candlestick, it looks like a hammer. I just think of MC Hammer back in the day. I'm kind of dating myself, but I wanted to ask you about that what you're saying. You mentioned the Business Roundtable, CEOs, CFOs. They just want to know what the rules are, how to work through that.
Right.
Do you think the current administration has a good grasp on the nuances with, like, just for example, autos? You have a lot of auto parts that are made outside the US. And in some cases, you got a part that's made here, and then that gets assembled to a part that's made in Canada, and then there's a piece in Mexico. Do you think that they're aware of how complex the system is? And if they are, is this going to be something that they say, okay, let's take a step back and let's try to figure this out? Because it's not black and white.
No, I would hope they're aware. But you're absolutely right. And it's not just about autos. The ecosystem of global trade is extraordinarily complex. And I think the sort of carpet bomb nature of this versus more of the, sort of strategic aims, that's what I think is adding to this uncertainty. The two biggest companies that export autos from Mexico to the United States are GM and Ford. they're not Mexican car companies that are sending their cheaper goods
Yeah.
to the United States. And you would think that the folks within the administration associated with trade understand this. Let's assume that they do. But what I find maybe more fascinating is that, and this is sort of the nature of the shorthand of headlining associated with tariffs. And I only
Mhm.
bring this up because I have had, I don't know, 5 or 6 really eye-opening conversations with really, really smart people that I am either friends with or associated with just in the last several months about how tariffs work. And the headlines of, tariffs on China or tariffs on Canada, tariffs on Mexico, fill in the blank, is suggestive of, and based on these conversations I've had with people that don't live in the weeds of this like I do, or aren't, an importer, so
Sure.
they're not impacted by this. I can't
Mhm.
tell you how many conversations I've had where I've said, all right, so tell me how you think tariffs work. And I had one just yesterday at a neighborhood block party where a woman said to me, well, in order for China to send their goods to the United States, they have to pay the tariff to the United States. And I said, that's actually not how it works. We all know this. We live in the weeds of this.
Yeah.
It's paid by the US company importing the good.
Mhm.
Now, who ultimately bears the cost is a function of, through negotiations, will the targeted country be willing to eat some of that cost? Or will the US company decide to eat that additional cost in their profit margins and or pass some or all of that added cost onto consumers? So that's really what should be discussed. But it's surprising to me how there's still this lack of knowledge of how tariffs work, and the fact that what we're really talking about is a tax on US companies. Who ultimately bears the cost? That is up for ongoing conversation and
Sure.
debate. But it's actually the simplicity around how does this system actually work that I think is more broadly misunderstood than I would have thought.
Interesting. Do you think that, like, all of this, we talk about sentiment, and sentiment's not great. Do you think that's more as a result of tariffs and uncertainty and business uncertainty, or is that more related to headlines with regarding to Doge and cutting and,
I
like,
think it's the
because I feel like
combination.
that there's more headlines there, but what are investors more worried about, in your opinion?
I think it's the combination. I think the Doge component of it is something that filters into concerns about the labor market because, admittedly, if you were to fire all federal government workers, it's not a huge percentage
Sure.
of the entire 162 million workforce that we have in the United States. The problem is a little bit more tentacled than that because for every one federal government worker, there's between 2.5 and 3 contract workers. And then Doge cuts are not just about cutting the federal government workforce. It's cutting other departments and
Mhm.
aid and grants, and that filters into the university world, into the medical world, into the education world, down into the state and local government world. So there's multipliers beyond just, okay, what are the federal government workers? What is the target of cuts there? So I think that's just added into the mix of this uncertainty that is unique. I guess the other, probably most important differential between the current environment and, say, the 2017-2018 period, because we've had Trump 1.0, we now have Trump 2.0.
Sure.
A lot of people try to figure out, well, how do we apply the playbook?
Mhm.
Is that one could argue that in 2017 into 2018, we got the candy first and the spinach later. We got the big tax cuts first and then the spinach via the trade war.
That's a good point.
Not only this time is it the opposite, we're getting the spinach first. The candy is really not as sweet because we're not talking about brand new tax cuts. We're talking about extending the 2017 tax cuts. Now, if they're not extended for whatever reason, that's a huge hit to the economy. But
Sure.
we can't consider the extension as an equivalent juice for the economy, as was the case in 2017, when they were significant new tax cuts. This is an extension. So that's another important difference between, call it then and now.
You make a good point. It's well taken about the tariffs being a tax hike on U.S. businesses and consumers, because from a macro perspective, about 2/3, a little bit less, of imports are intermediate goods,
right,
which go into final goods.
That's right.
So that's a rising input costs, and that's exactly why the stock market does not like tariffs, because it's a margin squeeze, and that could threaten the earnings outlook, of course, which is the mother's milk of stocks. But
that is, by the way, that's coming into play. So we're now in week 15 consecutively of downward revisions to 2025 estimates. We had a great fourth quarter reporting season. It meant that we had 17% growth in the fourth quarter. We closed out the year with 12% and change. The consensus for this year has gone from 15% at the end of last year to now 10%, and still in a decelerating pace. So absolutely, to your point, we now have this expected hit to earnings. And yes, if the consensus is right and we have 10% earnings growth, that's still double-digit earnings growth. But it's the direction that matters. I've been saying for my nearly 4 decades in this business to investors, better or worse, that often matters more than good or bad. It's the direction of travel that matters. And when we were at that 14 to 15% expectation for earnings in 2025, it was predicated on continuing with record-breaking profit margins. I think it's arguably a bit of a stretch to embed record-breaking profit margins into numbers given the effect of tariffs.
Yeah, I would concur with that. I was talking a lot about that just in the beginning of the first quarter, is how lofty expectations were coming into this year. And the irony, of course, is that 2023 and 2024 expectations were so low from a growth perspective after 2022.
Right.
It was very easy for these companies to continue to beat and outperform. And so we really have teed ourselves up now to be on thin ice, and we're starting to see that play out.
Right.
And as you said, is the revision's lower from an earnings perspective. So yeah, super interesting.
So that's kind of the lead in to the next kind of logical question. Stagflation, right? Slowing growth and concerns about some inflationary pressures lingering here. I personally think that stagflation risks are overblown. There's really been only one persistent or bona fide experience with that in history, and it resolved itself pretty quickly. But, play devil's advocate. How are you seeing it, Lizanne? Should we be more concerned?
I think the risks of stagflation are rising. And that's just simply because, to use a very simplistic lowercase s stagflation definition as deteriorating growth and sort of a deteriorating inflation backdrop, meaning lower growth, higher inflation, we're certainly seeing that in expectations right now. So it's a concern. It's an elevated concern. The mention of stagflation in news reports and headlines, the mention of stagflation and/or recession and corporate conference calls associated with reporting season have been elevated. So it is top of mind. I agree in the sense that I don't think the backdrop that exists right now is akin to the 1970s era, where it really wasn't sort of this singular episode of higher inflation and weaker growth. The problem in the 70s was sort of the fits and starts and 3 big spikes in inflation, all 3 times with basically the central bank, the Fed under Arthur Burns, with the benefit of hindsight, prematurely declaring victory after hiking rates to then say, okay, we've put the inflation genie back in the bottle. Let's lower rates, only to see the genie come back out of the bottle and escalate again. And it was 3 bouts of that, serious bouts of that led us to, Paul Volcker having to pull a Paul Volcker and bring on the back-to-back recessions in the early 80s. The conditions don't exist to suggest that kind of backdrop, but I think we're also decidedly no longer in the great moderation era from the mid 90s to the early part of the pandemic of essentially, decelerating inflation, but not just a decelerating inflation, very little inflation volatility, very little heightened concern about inflation that led to sort of fits and starts of monetary policy. So I do think we're sort of somewhere in between the Great Moderation era, which was so benign from an inflation and interest rate perspective, and the 70s era. I think we are in a more volatile period in terms of inflation as it relates to monetary policy. I think we're certainly in a more volatile period from a geopolitical uncertainty perspective. So different from Great Moderation, but no, not akin to what was experienced in the 1970s.
You mentioned companies citing terms in recent earnings calls. For the word inflation, yes, it's still a bit above the long-term average, but I would point out that it has been coming down, and it seems like we're making progress. At least companies don't seem to be kind of spiraling out of that control yet.
Yeah, right. The question is there accuracy to inflation expectations measured by things like, UMISH consumer sentiment that has seen both 1 year and 5 year forward inflation expectations kind of go parabolic. So there's obviously a fear about that, whether it manifests itself in actual. Now, the one other thing I'd say about that is I think tariff proponents will point out that tariff related inflation is more of a sort of call it a one-time, reset up in the level of prices. Yeah. I don't know that I think it's as simple and pure as that. I think because of the complex ecosystem of trade, and to your point about just, the inputs and how it feeds into final goods and the pass on, I think it probably is not just simply some one-time tariffs get announced, prices jump, and then they don't jump again from there. But here's why it may matter is we think of inflation as a rate of change. And I agree that tariffs probably don't mean persistence in that month over month and year over year increasing rate of change. But guess what? Most consumers think of inflation in level terms. They're not in the weeds of month over month, core versus headline, core services X housing. And they think of it as, hey, prices are more for this than they were, X period ago, 1 year ago, pre-pandemic, whatever the reference point is. And that's where it does feed into psychology. Part of the reason for the election result was grave concerns about the level of inflation, even though the inflation rate, you're absolutely right, had come down from, a 9 handle on CPI to a 2 handle on CPI. But constituents were still kind of freaking out about the level of prices. So it does matter to consumers because that's the way they think of inflation.
Ask a couple follow-up questions on inflation. I've just been thinking a lot about this whole theme of electrification, all this build out in AI. And I read something recently, China, apparently in some places they were building out, but the operators building out the AI data centers didn't know what they were doing. And so now they have some empty data centers in China. And so it reminds me of like the ghost cities that they had in China. But like for here in the US, we're still going strong. There's still a lot of focus there. They're going to get better and they're going to get more efficient in how they do it. It feels kind of messy, but exciting at the same time. That should help with productivity and that should be disinflationary, right? And
eventually, yes. And I think,
but how long do you think it takes before we get there?
I think another very important thing has happened over the last several months that maybe because the news came out, I think it might have literally been on Inauguration Day and subsequently got overshadowed by all of this news and uncertainty regarding tariffs and Doge, is the DeepSeek news.
Yeah.
And I think it was not just important, the specific news that, or the headline of, a Chinese AI company figures out how to create a large language model for $5 million as opposed to the hundreds of billion dollars that have been spent. It wasn't just that specifically, but I think it represented, I think, the beginning of the creative destruction that naturally and always happens when you have a massive new innovation and tremendous amount of money is spent by the early leaders in developing the infrastructure and creating the backbone of whatever that technology is. And a lot of people don't realize that because, again, the shorthand of headlines of, Chinese company DeepSeek, well, DeepSeek came out of a quant-based hedge fund, kind of deep in the recesses of China. And China
Sure.
hates hedge funds. The point being that this wasn't some state-owned enterprise. It wasn't being monitored
Yeah.
by the party authorities. It really is suggestive of the disruption has started, and it happened to come out of a hedge fund out of China, but it could have come out of, India, it could have come out of Sydney, Australia, it could have come out of a
Sure.
garage in Des Moines, Iowa. And this is what happens. And we are seeing a little bit of pullback in some of the lofty assumptions around the AI spend.
Mhm.
And now thinking to your point of, okay, now that a lot of the sort of infrastructure has been created, how do we build this out via data centers and the energy needed to continue this process of democratizing and, to your point, bringing it at maybe a lower cost to industries and companies all over the place. And we already had the perspective as we ended 2024, coming into 2025, that, and this was before DeepSeek, before all this turmoil and uncertainty with regard to tariffs and trade, that one of the themes in the market, in the economy, in behaviors would be from all the focus on the infrastructure, the mortar of AI, to how is this going to be broadly more utilized for the benefit of things like productivity? And I think that disruption is happening a bit more quickly. And I think it's ultimately for the greater good of the economy and that creative disruption that democratizes access. But it also helps to explain why, the Mag 7 went from the Mag 7 to the Lag 7 this year, and that's where the pain point has been within the market.
Do you think part of the concern about China is that they have caught up? I mean, it feels like for a while before the DeepSeek moment, people were saying, "Oh, they're years behind. They don't have the right chips, and we've got the position." Right. It feels like it's a lot more like a level playing field.
Yeah, and it's not, again, it's not just that China has caught up more quickly. It's that other places, other people, other innovators, other technologists, other coders can kind of catch up. It's sort of a model for that creative disruption. But yeah, I think we should never discount what China can and what China endeavors to do. Be it perceived as nefarious or illegal or how dare they, it is what it is. And you're seeing it in things like what they announced with regard to their battery charging infrastructure associated with electric cars, and they got it down to 5 minutes, which is about as much as it takes to fill up certainly a tank of a big SUV or a pickup truck. So I think we have to be mindful of disruption coming from lots of different angles. And when you have a very loftily valued market, that is sort of one of the fundamental drivers of this corrective phase we have been in. It's not just about broad macro policy uncertainty. It's valuations get rich and then you have disruptions that happened. I'm not suggesting we have an extreme like 2000 to 2002 ahead of us.
Oh yeah.
But that was an example of a massive new innovation that was game changer and it was world changing. But then valuations then it was really ridiculous because momentum was the dominant factor back then, but that's not really a fundamental factor. That just means stocks that have been working continue to work. What's interesting is the fundamental factor most highly correlated to momentum driving performance in 99, 2000 was negative earnings. Now, when we had momentum in the driver's seat from a factor perspective, that kind of ended this year. But the other factors most highly correlated to momentum were things like positive free or strong free cash
quality,
flow, strength of balance sheet, high interest coverage, So a strong return on equity. So the momentum arguably was in the richly valued companies, but there was more there than was the case in the 99-2000 period of time.
It sounds like we started to talk about Chinese exceptionalism there for a second, but I joke because we're kidders, but I mean that's something real. I think what this does, the DeepSeek news, and I think Baidu had a response that was pretty similar and cool, but it just accelerates my theme that what is pressuring the producers here could actually be very good for the users of these
absolutely.
technologies, because now we have more competition and they're able to do it at a potentially significantly lower cost. And that would be, I think, Lizanne, the counterpoint to the margin pressure argument. So, perhaps that's the kind of holy grail here in this environment. That tech
that's
kind
sort of
rescued margins.
The kind of light on the horizon,
right,
in dealing with all this other policy related
right.
uncertainty. And it really explains some of the rotations we've seen in the market and some of where strength has resided in areas like energy and utilities. There's the AI component of that too. Mm-hmm. So we're seeing it manifest itself in rotations within the market. Mm-hmm. And I think many of those have more fundamental explanations to them, as opposed to just everyone's uncertain about tariffs and Doge. So, we're going to throw all the, market babies out with the bathwater. There is still some fundamental swirl going on that's related to some of this disruption.
Paisley, jump in here.
Yeah, I was just going to ask, two questions. One was just kind of on the backdrop of that rotation trade. I think a lot of investors are wondering if this was a blip, right? If you zoom out, as Jim puts it, in some of his recent commentary, but if you zoom out and kind of look at the longer term picture, this outperformance of international stocks versus US over the last quarter is barely noticeable long term, but it was meaningful just given the backdrop of uncertainty we've seen. So do you see that continuing to play out? And is this the beginning of kind of a new regime as it relates to diversification in a U.S.?
So I think when you look at the very long term on cycles of outperformance by U.S. and then periods of outperformance by non-U.S., so the broad bucket of international, which sometimes is bias a little more on the emerging market side. Sometimes it's biased a little more on the developed market side. But you do tend to go in long secular cycles. And it wouldn't surprise me at all if what we're seeing on a year like this, where you've got MSCI EFA up 8% year to date and the S&P down 5% year to date. That's a 13 percentage point spread. That's meaningful. Mm-hmm. Yes, albeit for a limited period of time. I do think this could potentially be the beginning of a cycle of maybe not consistent outperformance by non-US. I think that's too binary a way to look at it, but a backdrop where it is not a tough sell. It becomes less of a tough sell to talk to investors about the merits of being diversified across equity asset classes, inclusive of international. That obviously becomes a tougher sell when the U.S. is perceived to be the only game in town and it manifests itself in relative outperformance. But I think this shift may be an important reminder to investors of the benefits of diversification across asset classes. And I think the same thing within asset classes. You're going to have plenty of bouts of outperformance by the tech and tech adjacent areas, maybe even the Magnificent Seven. I think that there's still that desire. There's that knee-jerk reaction. There's still the love for what may be yesterday's darling. So that transition takes a little bit longer. But I think we have an environment where a larger share of an index like the S&P is outperforming the index. A year, if you look at the trailing 1 year period, only about a quarter of the S&P's constituents outperform the index. Over the trailing 1 month period, it's more than 60%. Mm-hmm. So we're getting some price discovery again and reconnection of fundamentals to prices, all else equal. And that's a hefty statement these days. I think that's good. It's good for stock pickers. It means a more level playing field for active relative to passive. Yeah, it's not saying active is going to crush passive now, but a more level playing field, and that's not a bad thing. But that
Yeah.
doesn't mean we avoid, corrections or bear markets. That's just
Yeah.
part of market cycles.
I
Well,
concur. I've felt a little bit of that sentiment too, despite markets kind of broadly selling off. I think there's comfort in seeing that the breadth has returned to the market. And just like you said, showcases pockets of the portfolio that have been the negative line item for the last 10 years. And it's reminding like investors from a psychology perspective, the importance of not having all of your eggs in one basket, because it's
Absolutely.
very rare that continues for, more than a
Correct.
couple of years, as we've already
Correct.
seen.
Yep.
I was going to say, we love a good growth scare because, and this one's no exception, because it's too enticing for long-term investors like us to avoid shopping the sales. But I don't think we actually ask you. So maybe we can kind of put a bow on it here. Correction or bear market. So to us, this is hopefully, I know that's not a strategy, but it's looking more like a garden variety correction with some reasons to buy. But what do you think? What are you worried about a bear market here?
Ultimately, when you get to 10% correction point, which we have, the decider as to whether it morphs into a bear market or not is often based on whether you get a recession or not in some relative short order, some semblance of, adjacent to the correction. So I think the uncertainty with regard to recession risk rising, but the fact that none of us can kind of guess what's going to happen from a policy perspective, which is what's leading to rising recession risk. I'd say the theme of this year on questions like that is the shrug emoji. I have no idea, but I think that will be a kind of a key determinant. But I would also say that we have to be a little more of a deep diver when talking about the market. So last year, as a for instance, was seen as this great year for the market. S&P was up, I think, 23% for the calendar year, and it didn't have even a 10% correction throughout the course of the year. The biggest maximum drawdown was, I just doubled that terminology there. The maximum drawdown was only 8% from mid-July to early August. But the average member within the S&P 500 had just about a bear market level decline. Now, the NASDAQ at the index level did have a 13% drawdown in that same late summer period of time. The average member within the NASDAQ had a negative 49% maximum drawdown. Similar things are happening this year. So we did hit correction territory with the S&P, more so for indexes like the NASDAQ and the Russell 2000. But even at the worst part of the correction in the S&P, the average member maximum drawdown just year to date is 15%. The average member maximum drawdown for the NASDAQ is negative 34% just year to date. So there's a lot more churn and weakness and rotation under the surface. Now, I think we would all choose a market where the weakness churns under the surface and you don't get, the bottom falling out all at once at the index level. But to be perfectly honest, the fuller story of what the market is doing is told under the surface of the indexes, not just at the index level.
Point.
And people say this year, well, yeah, but it's not the large cap growth stocks. It's not the Mag 7 leading anymore, yet the indexes are still hanging in there. Well, it's large cap value. Of the four big, Russell indexes, Russell large and small growth and value, Russell 1000 value is the only one up this year. So it's still large that is supporting the market. It's different large stocks, but that keeps index level changes more muted. The fuller story is told under the surface.
Yeah,
Lizanne, we're almost at the top of the hour here. It's great to see you all fired up, and thanks for coming on the pod. Is there anything that we haven't said that you want to kind of take us out on? Maybe a high note?
Well, I would say that a lot, if not most of what we talked about doesn't really matter to what investors should do. It's not what we know that matters, meaning about the future, because it's inherently unknowable. It's what we do along the way. And I think the way often market discussions happen, especially in the world of financial media, much less so in a podcast format because they're long form. You can get into the meat of things. You can answer in full sentences. But, the traditional financial media, probably the most common question I get from the media, particularly when you're in market turmoil kind of, CNBC is having their markets in turmoil 7 p.m., special is, okay, Lizanne, what are you telling your investors to do? Get in or get out? And I always think, boy, that's not a good question, because neither get in nor get out is an investing strategy. All it is gambling, not just on a moment in time, but on 2 moments in time. And no one is successful trying to do that. So it's the disciplines along the way that make us good investors, not trying to time what the market is going to do in the short term. So it's what we do along the way that matters, not what we know about the future that matters.
Absolutely.
So I've got a follow-up question. Last one, I promise. So having said that, instead of being in or out with the markets, where would you put your next dollar? Like if you're fully invested, the next dollar, where would that go? Would that go to U.S. equities, large, small, international,
I think
bonds?
The momentum, well, it depends on what the dollar is there for.
Yeah.
That's another thing I don't like, is direct answers to a question
for
like
you,
that.
For growth. If you want to,
well, I mean, if you're an older investor and you've built a retirement nest egg and you can't afford to lose any of it and you're living on the income generated from it, I'd say be really careful about the riskier segments of the broad asset class uniform, inclusive of equities, period, whether it's international or domestic. So then you want to take advantage of decent cash returns and decent, safe fixed income returns. But if it truly is, where is the opportunity there? I'd say within the U.S. equity market, I think you want to stay up in quality. You want to focus on factors like, strong free cash flow, resilient profit margins, lower volatility. That's what has been working from a factor perspective within the U.S. market. And yes, have some international exposure as we think we're in maybe one of these more secular transitions. But there's no cookie cutter answer that applies to all investors. It depends on who the investor is.
That's right. Well, I want to thank you for your time. We only had you for an hour. We went over by a minute. That's pretty good.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.